Now looking at the possibility of an interest rate cut, with some saying that funds are now starting to move from the fixed income market into the equity market. Is this the trend that you are seeing currently?
Yes, given how the markets have been in terms of creating investor confidence and the way forward in terms of how to be able to handle the aspects of liquidity in the market, we've seen that a lot of investors are moving from the government securities onto the equities, given the fact that there's expected interest rate cut in the coming month. And also the reason why investors are moving is because they want to see exactly the percentage of the cut in terms of the interest, how it's going to be and how it's going to be able to impact on the returns on the investment. Also given the fact that there are a lot of variables and fundamentals that the government through central bank and the Ministry of Finance need to address as far as investing in the government securities is concerned.
There's talk of a rate cut coming through possibly next month or even in August. When do you see the rate cut coming through and by how much?
From how things are, probably by mid of next month, and probably not more than 2%, given the fact that given the measures that central bank had been put in place to be able to measure up or firm up a few variables that are actually mitigating the slide of the economy. This will actually go into place to determine what percentage, but I don't see it going more than a 2% digit. And also the other variables are actually going to come into play. For example, foreign fundamentals like how the euro issue is going to be handled, how the local shilling is going to firm up against the dollar, not to put in other local variables, politics, how the government is going to handle the issue of debt, and how to mitigate the big deficit in the budget.
Let's touch on the foreign participation on the local bourse. Like you said a little earlier, talking about the Eurozone and troubles coming through from the Eurozone. Where are foreign participants placing their money at this stage?
Yeah, at the moment, we're seeing that foreign investors actually shifting gold to manufacturing and industrial stocks like Bamburi, Portland cement. This is because when you're looking at the sector, it's one of the key drivers of the economy. We've seen a lot of infrastructure changes in the country, a lot of money from development partners, and even the government has been pumped into this. And we're seeing that the fundamentals in these stocks are actually more stronger, that can be able to withstand the issues or the problems that the euro is actually experiencing. We're seeing that they're shifting from key liquid stocks in the finance and services and allied industry to manufacturing. And this is because until issues in the Eurozone are actually being able to handle, because statistics coming in are showing that emerging markets like Kenya are going to lose more than 30 billion euros in terms of investment and development because of what is happening actually in the Eurozone.
That's going to be quite a big impact. Now, when we spoke a little earlier, you were also saying that you are pretty keen on the banking sector at this stage.
Yes, because the interesting variables happening in the banking sector. One, we're seeing that the central bank has actually come up with new rules that are going to ensure that the current banks that are listed on the market change the board within the next few weeks. That is one. And we're seeing that a change of management will actually affect change of strategy, which invariably will actually have an impact on how the shares will perform on the market. We're also going to see that with the problems in the euro, we're going to see how the banks are going to be able to mitigate this kind of a problem because of the interconnectivity between our local banks and international markets. But we're also seeing that our export business is actually going to be affected by at least 28%, which invariably means banks are going to be affected in terms of the bottom revenues at the end of the day, and how the local currency is going to actually firm up against international currencies, the dollar, the euro, and the pound. And also given the fact that given that we import 8 times more than how we export, these are issues that the banking sector needs to mitigate. Policy from the central bank and how it's going to handle in the coming days.
Now, looking at the banking sector, which you are pretty keen on, which would be your favorite stock pick within that sector?
At the moment, I'll be looking at KCB. It has strong, pretty good fundamentals, regional good expansion. I'll be looking at Equity Bank. I'll be looking at National Bank. It's changing its CEO. I'll also be looking at Diamond Trust and Barclays Bank.
Now looking at the currency, the shilling's trading at around 84.15 against the dollar, with some saying if an interest rate cut does come through, we could see the shilling hitting levels of 90. What are your thoughts on that?
Given the fact that we have the central bank has been supporting an unsustainable exchange rate, that the imports are 8 times more than the exports. The current debt keeps growing. There's a huge deficit in the budget. Many people are wondering how the government is actually going to plug in that deficit, and also given the problems in the euro and how the effect, when the European man sneezes, the African emerging markets catch the cold and the cough. So it's going to be pretty interesting to see how the shilling will actually perform. But you see, the problem is not to put in local issues like politics, key government policy on key issues that are support the macroeconomic indicators of, say, the agricultural sector and the industrial aspect. We're going to see that the shilling is actually to even slide more to 93, 94 in the coming days.